I know all of this from experience, and I'm not here to sell you a course. Use the timestamps to jump around, because this is going to cover almost everything. Thinking you need 25K to day trade is a misconception, even for options. There are two types of accounts, margin or cash. With a cash account, you can do as many trades as you want as long as the money used doesn't exceed the balance of your account. All of your funds will be ready to use the next trading day because options settle overnight. The other way to avoid this rule is to just completely avoid options and trade futures instead. You can watch a video about that in the top right. This is the traditional option chain you will find if you're serious about getting into this kind of trading. Doing swing trading and basic options plays involved with investing are fine on brokers like Robinhood, like cash secured puts and covered calls. Some people will get mad at you for using Robinhood because of the GameStop situation a while back, but if you haven't figured it out by now, brokers aren't your best friend. They want you for your money, so use whatever platform feels best to you. However, if you want to do something like this, you need to get on something useful like Interactive Broker seen here with their Trader Workstation platform, or get an account with TD Ameritrade and use their Thinkorswim platform. The option chain in this picture is from them. Of course, there are other options for brokers, but these two are some of the best. Personally, I put a few thousand into Interactive Brokers and day traded the opening range break strategy on Tesla with a cash account. The tutorial for that trading style is in the top right and the description, but it's a bit too intense for most people. Okay, let's go over the super basics. It's not as simple as buying a call when you think the stock will go up and buying a put when you think it will go down, although that is the start. Every trading platform has a different looking option chain, and once you can read one, you can read them all. This is Robinhood, and theirs is probably the most simple because, well, that matches their target audience. We'll use this one to discuss the basics, including which strike price you want, and then we'll look at the option chain on Thinkorswim, which is much more advanced. Okay, if you're betting on a stock going up, you buy a call. The worth of the contract increases when the underlying does, which in this case is Apple. When you hear the word underlying, it is referring to the stock that the option derives from. Options are derivatives because their value derives from something else. Trading options doesn't affect the stock price. The stock price affects options. The only exception to this is when someone exercises their contract, but that's coming up later. So you think Apple is going to go up and you want to buy a call. If your plan is to buy and sell this contract the same day, you want to make sure that the option you are choosing is the closest to expiration. For all brokers, somewhere there will be a date on the option chain. For Robinhood, you see it in the top right. All options expire on Fridays. Regardless of how far in the future the contract is, it will expire on a Friday. As the Fridays get farther and farther away into the future, like 2 years from now, they become less liquid. This means they are traded less and therefore will have a farther spread between the bid and the ask. When you're day trading, you use the weekly options. So, you trade the contracts expiring on the closest Friday to you. I know you would rather trade options on the Friday from last week because you are great at trading what's already happened, but that's just the way the world works. I know this can be a lot at once, so feel free to watch this video as many times as you want. Click on all the ads, buy things from the ads you click on so they give me more than 2 pennies. Whatever you want to do, I'm cool with. You trade options expiring the same week you were trading them. This is because they are the most traded ones and it will lower the difference in the bid-ask spread, which is the difference between the price buyers want and the price sellers want. This spread is dependent on the amount of people trading as well as the price of the options themselves. With Apple, it could be just a couple dollars, but with something like Tesla, it could be anywhere from $20 to $200. The more volume being traded on a contract, the smaller the spread will be. Try to contain your excitement, but get ready for some more vocabulary that you need to know. Options on the option chain are described as in, at, or out of the money. For a call, at the money would mean the strike price of the contract is basically the same as the underlying. So, if Apple is at 200, an at the money call option would have a strike price of 200. Out of the money call options would be anything beyond 200, and in the money call options would be anything below 200. Don't worry, we will talk about why there are reasons to trade the different strike prices right after this. If Apple is at 200, an at the money put option would have a strike price at 200. Out of the money puts are strike prices below 200, and in the money puts are strike prices above 200. Notice how it's opposite. That's because for a call option to become in the money, the underlying, which in this case is Apple, has to climb up in price to get to the strike price. A put option with a strike price below 200 is out of the money because Apple has to fall in price and meet it to become at the money and then in the money. Think of the out-of-money options as being far away from the current trading price, and the stock needs to fall or climb in your desired direction to become in the money. Out-of-the-money options are cheaper, and in-the-money options are more expensive. The bid-ask spread is usually the smallest for at-the-money contracts because most people day trade with strike prices that are closest to the underlying. Why? I don't know. I'm just a plumber. Nah, I'm just kidding. Okay, time for some nerd stuff, but you really do need to understand this part, or you will make some seriously painful mistakes like the rest of us. Time to talk about Poseidon, Zeus, and the Greeks, minus the first two parts of the sentence that might make this section almost interesting. So why are there all these different strike prices? Why would I buy one call option at the money for the same price I could buy 10 of them for out of the money? Let's talk about our little friend Delta, probably the most important of the Greeks, and one that you actually have to understand. Delta is measured from 0 to 1, but you'll never see that. You will see delta as being from 0.01 to 0.99. What does that mean, Mr. I-Man Trading, if that's even your real name? For every $1 change in the underlying, the worth of the contract changes by delta times 100. What? I know. You see here that options are listed as if they cost a couple of dollars. I don't know why they do that. To save space, maybe? The price you see on the options chain are 1/100th of what they actually are. So that $1.94 contract is actually $194. Let's say you've got a call option that costs you $100 and it's got a delta of 0.5. When the underlying moves up by $1, your call option is now worth $150. If the underlying went down by $1, your call option would be worth $50. If it was a put, a $1 move down and the underlying would increase the worth, and a $1 move up would decrease the worth. Look at this option chain. The left side is calls, and you should be noticing a trend in the delta column for the calls. The farther in the money an option is, the higher delta gets. Delta goes down as the contract moves farther out of the money. You'll notice that the delta column for puts on the right moves the other way. So now that you are an expert with understanding delta, you should begin to get an idea of which option you would want to buy. You could buy a super cheap and far out of the money call option, but its value might only change by $9 when the underlying moves by $1. Or you could buy one expensive in the money option with a super far spread, lose $200 just getting in, but have the option's worth change by $89 for every $1 move in the underlying. Let's temporarily ignore the part about the spread though, and save it for the order types section. So, what are you willing to risk? How confident are you? Do you want to buy something that changes by $9 when the stock moves 1? Or do you want your option to change by $90 when the stock moves 1? Most people trade at the money strike prices. They're the most traded throughout the day and they have deltas around 0.5. So you're getting $50 worth of movement every time the underlying moves by $1. Remember that delta is dynamic too. The further in the money the option becomes, the more that delta increases. If the underlying moves against you and the option is moving farther out of the money, it will change less for every $1 movement. So, the short answer is to trade at the money calls and puts. Which contract this is depends on the underlying's price, which will change throughout the day. This means the strike price that is at the money is going to change as well, and traders will adjust which contract they choose throughout the day. And speaking of time, let's get into the Greek that, combined with my stupidity and degenerate decision-making, cost me a few $1,000s. Theta. Yuck. We are going to nail this one, and then we'll talk about a few strategies that involve using time to your advantage. You can either trade like the degenerates, or you can sell options to the degenerates. Your choice. Or both. Or neither. I managed to lose money doing both. I'm just kidding. Sort of. No, I'm not. So I gave a bit of thought to this on how I wanted to approach explaining this. You can get seriously complicated with this or keep it real simple, so let's do a little of both. What you need to understand is that options can expire worthless, and they lose value as time goes on. I know. Boo! On expiration, which is the end of the day on Friday, all out of the money options expire worthless. I repeat, worthless. $0. From the moment you buy an option, it is slowly losing value. This is referred to as extrinsic value, meaning the time, but we aren't going to go over intrinsic versus extrinsic. It's boring, and you don't need to be able to write a paper on how options work to be successful with them. Options slowly lose value, but the speed at which they lose value increases the closer you get to their expiration. So, When you're day trading on the Friday that it expires, you don't want to hold positions super long. Theta is a column in the options change that will look something like negative 0.15, but that number gets higher the closer you are to expiration. It's okay to hold an option overnight as long as this option has an expiration that's very far away, so you're not just losing $30 from market close to market open. So with a theta of negative 0.15, this means that a call option of $2, which is really $200, will go down by 15 cents, which is really $15 per day. Remember, theta goes up the closer to expiration, so they start losing value quicker. This loss in value slowly happens throughout the day, but causes large drops in value from close at 4 to the open at 9:30 the next day. Implied volatility. Jonathan buys a call option on Apple because he expects them to beat their next earnings report. Before the market open, Apple reports that they beat earnings expectations by a whopping 10%, and their stock soars upwards. Jonathan is like, woohoo! Can't wait to see how much my call option is now worth. So it hits 9:30. Jonathan checks his position, and he is shocked to discover he is currently down 20%. Jonathan goes, oh my god, maybe I should have fully understood how options worked before I made a play that literally everybody has thought of in the history of trading, and I'm not the next Albert Einstein of the markets. Just kidding. Jonathan got mad at his broker and made an angry post on Reddit about how the market has robbed him of his money and it's not his fault. Let me introduce you to the phrase, everything is priced in. Sure, you can make plays believing certain events are coming up that will influence the price, but guess what? The people who do this for a living have access to news before you do. The price of an option is partly calculated based on how much it is expected to move, which is called implied volatility and is represented as a percentage. A stock's chance of making a big move up or down is almost entirely priced into the contract already. Not only do you have to be right about the direction, but you have to be more right than what the market already expected. Stocks almost always make big moves after an earnings report, so implied volatility increases leading up to these. This causes options to cost more money, and as soon as the earnings report is out, implied volatility drops down, which significantly lowers the worth of each option. You will hear this being referred to as IV crush. This is how you can be right about the direction and still lose money. Implied volatility is something you will often see in the option chain, or at least have the ability to add as one of the columns. However, with day trading, it doesn't really matter. It only matters when you hold an option for a while. IV going up increases the worth of the contract, and it decreases the worth of a contract when it goes down. There are options plays solely based on making money off of the changes in implied volatility, but those strategies are probably a bit too advanced for the intended audience of this video. Let's get the basics of cooking down before we try to become Gordon Ramsay, you know? So we've learned that options are constantly losing value all the way to their expiration because of theta/time decay. We know that we can pretty much ignore this if we are day trading with short holding times. It's almost never a good idea to hold short-term expiring options overnight, and it's never a good idea to buy options right before earnings. This is because implied volatility goes way down after earnings, significantly reducing the value of all options. And implied volatility is different for all stocks. Something like Riot Blockchain, which is a crypto mining company, has a way higher implied volatility than normal. Since it moves to relation in Bitcoin, it goes up and down by large percentages all the time. This means that the options market has priced in these ginormous moves. So, implied volatility is way higher in order to compensate for the huge expected moves. It would be lower in something like Apple, because huge moves are rare. Most things are priced into the options market, and thinking you've figured out something that nobody else is expecting usually results in massive failure. I say that from experience, but hopefully you can vicariously learn that lesson through me. You also know that delta is how much the worth of the option will change based on a $1 move in the underlying. So, one call option with a 0.5 delta will have its worth increased by $50 when the underlying moves up $1. If you had a position size of 2, meaning you bought 2 call options both with a delta of 0.5, a $1 increase in the underlying would result in a $100 increase of your options position. You also know that you choose a strike price based on which delta you want as well as what you're willing to risk. The farther out of the money, the more likely it is that the option will expire worthless. But remember, many of these things don't really matter for day trading because we're buying and selling very quickly. If you want to hold an option for a few days or few weeks, you need to buy an option expiring far into the future so that the position doesn't lose too much solely due to theta/time decay. So we've gone over quite a bit, but let's go over even more. First of all, how much money can you lose buying options? If you buy a call option expiring next Friday and it cost you $300, $300 is the most amount of money you could lose on the trade. See, unlike buying a few shares where you just lose the exact percentage that the stock has moved from the time you purchased it to now, options can expire worthless, but you'll never lose more than your initial investment. Of course, there are ways to make really stupid decisions and lose a lot more money than what you started with, but let's keep it simple for this video. I only brought that up for the people who are going, actually, you can blah blah ooga booga. Covered calls, aka free money, until it's not and you lose a lot. You can own 100 shares of a company you love, like Apple, and then you can sell calls using the 100 shares as collateral. Upon expiry of the option, if the share price is trading at or above your strike price, your shares get sold away. You could collect anywhere from $20 to $200 per month on shares that you already own by doing this, or less or way more. When everybody hears this for the first time, they go, ooh, free money. Sort of, except that if the underlying moves up past the strike price of your option, your shares get sold away at the strike price and you miss out on the rest. So let's say you own 100 shares of iMan that you bought for $10 a share, costing you $1,000. Smart choice. You sell a call option with a strike price of $10.50 expiring next Friday. No matter what, you always keep the premium you got by selling the call, even if the shares get called away. What you are selling is basically time, theta, extrinsic value, blah blah blah. So if iMan goes up 5% or more by next Friday, your shares get taken from you and are sold for $10.50 a share, no matter how far past that it goes. If it finishes Friday at $10.49 or below, you keep your shares and of course the premium as well. Let's say you get $15 for selling that call. So you keep your shares and now have $15 more. Yuck, only $15? Yeah, but that's a 1.5% return in just 2 weeks. You do that 10 more times, and in 20 weeks, you'll have yourself a 15% return on your investment. Many hedge funds and so-called professionals don't make that in a year. That would also be outperforming the S&P 500's yearly average return, which is the benchmark traders and investors use to see if they'd be better off just dumping all of their money into ticker SPY or VOO, which is the ETF of the S&P 500. Okay, so holy crap, this is free money, oh my god. No, let's say that iMan goes to $15 on that Friday. Guess what? All 100 of your shares get sold for $10.50. So you make the 50 cents gain per share plus the premium of the call option, which is 50 plus 15. You make $70 instead of the $500 you would have made if you sold your shares at this point. So, covered calls are all about being extremely patient and making a tiny bit of money over time. And this was just a very brief introduction. We're not going to go over rolling out your options farther into the future in order to not have your shares get called away. They can be great and they can be very bad as well. You can spend 3 months just making a little bit of money on selling options, and then you can miss out on making that plus more because it goes up a lot past your strike price due to some random event. Also remember that making 1.5% from the premium was just the example I used. Most of the time it will be way lower, and anything that is super high because of implied volatility has a good chance of blowing past your strike price and causing you to miss out on money. It's a fine balance between risk and reward. Cash secured puts. Cash secured puts will be the second non-day trading option strategy we will talk about. The smart way to do this is to sell puts on companies that you want to own. Let's say iMan is trading at $15 and you're like, whoa, yuck, that's super overvalued. Ow, that hurts my feelings, but okay. So you being the smart investor says, hey, I want to own iMan at $12 a share, so I'll sell a put 3 weeks out from now at a $12 strike price until I am assigned the shares. So, with a $1,200 cash balance in your portfolio, you sell a put 3 weeks out with a strike price of $12. You collect the premium of, let's say, $60 for selling that put, which by the way is way more than what you would actually get. So that 3 weeks goes by and the option expires with iMan still trading above $12. Now it's at $13. So you sell a strike price 1 week from expiry and you collect another $60. It's the same amount of money for less time because the strike price is closer to the underlying. So IMAN goes to $11.80 and you decide to exercise your right to the contract. This causes you to gain ownership of 100 shares at $12 per share. Since IMAN is trading at $11.80, you are currently down $20 on the position. But remember, this is an unrealized gain. It's only a number on paper. Until you sell those shares, the loss or gain does not really mean anything. So you sell cash-secured puts on companies you want to own. You get to keep all the premiums from selling options until you end up with shares at a price you like. You have to have the total cost of the potential purchase as cash in your portfolio, because the broker needs to see that you'll be able to cover the cost. So if you're selling a strike price of $10, you have to have $1,000 of just cash. If the strike price is $100, you need $10,000 of cash. Cash-secured puts can be very effective, but many option strategies are not as good as just buying an ETF, if not done right. Do your research into these to fully understand them, since this is just an introduction to get your brain shaking a little. Doing a little dance in there. If you don't truly understand options and just start doing all kinds of weird strategies from that guy on Reddit, you'll end up making very painful mistakes. Many of these mistakes can be avoided instead of doing them like I did, so check out some of my psychology videos if you want. That's the main thing I upload. I have a bachelor's degree in behavioral science and absolutely love psychology and its relation to the markets. The mental side of trading is where the majority of people make boo-boos. At some point in your journey, you will realize that trying to learn the next indicator is not how you become better at trading. Or you could realize that now and skip the pain. You have to get out of the loop of thinking that the answers to your problems can be found by watching another secret mindset video. That ginormous side of YouTube trading exists to make money off of you, not from actually trading or doing any of the things that they talk about. I will try not to fall asleep as I talk about the different types of orders, but let's get something straight first. Beginners put way too much of an emphasis on what type of order you should do. The opinions of other traders don't really matter because most of them aren't even making money. So next time you hear someone get all upset and become a keyboard warrior about why market orders on options are bad, remember to tell yourself that this person A, is most likely a beginner, B, probably has lost more money than they've made, and C, doesn't realize that they are just a random person on the internet, not the main character of a story. With that said, let us begin. Market orders grab whatever is available, and limit orders wait for something you want. Let's talk about a concept that even many experienced traders don't understand though. Let's say you place a limit order on a call for $100 with the bid at $99 and the ask at $110. Guess what? 99% of the time, you thinking that you'll get a good deal by using a limit order just means you won't get filled at all. Or you have to wait for the bid-ask spread to be more like $95 and $105. Then you might get filled on your limit order for $100. But you might not. Now you're getting all stressed because all this time it's taking for you to get into a position might be causing you to miss the play. If you are just swing trading or doing longer plays, then sure, use a limit order. But if you're making 30-second trades, you need to use a market order. You don't want to risk missing an entry, and you especially don't want your closing order to not get filled. That's a quick way to end up with massive losses. So choose between getting the bad side of a deal with market orders but always getting in and out, or miss trades and stay in losing positions while scrambling to set a limit order price that allows you to get out. You have to pick your poison. If you're doing fast trades, market order. If they're long trades and you're in no rush, limit orders. Most of the time, a market order will get you in close to the middle of the spread, but other times it's closer towards what seems like a very bad fill. You can either learn all this from me or experience the pain of watching your portfolio quickly drop in value while you scramble to get out of a position using limit orders. Personally, I used market orders when I did my fast opening range break strategy on Tesla, which is the same as what Matt Diamond does. Those 6-second trades I did would not have worked with limits. Additionally, while trying to use Interactive Broker's algo trading meant to get better fills, it just caused me to miss entries and lose profits due to taking multiple seconds to get in and out. What's important to know is that there is no perfect order type that prevents you from losing money to the bid-ask spread. There is just a cost to play, and each type of order has their costs and benefits. There are stop markets, sell limits, and a few other neat ones, but we'll keep it simple for now. You can check out the other types online. Check out some of my other videos about psychology and make sure you know the truth about technical analysis right here. Thank you so much for the financial support, which allows me to make these for free.